You know the feeling, right? You spot an initial public offering, an IPO that just looks incredibly promising. You absolutely want to invest, but then there's that nagging fear in the back of your mind. What actually happens to your money when you hit apply? Is it just gone for weeks? What if you don't even end up getting the shares? Does your hard-earned cash just sit in some weird financial limbo? Well, okay, let's dive into this, because today we're going to completely clear up exactly how your capital is handled during this whole process.
Welcome to today's Explainer. Today, we are demystifying ASBA. We're going to break down the official guidelines straight from SEBI, the Securities and Exchange Board of India, to show you exactly how this system is built from the ground up to keep your IPO funds totally safe, accessible, and firmly under your control.
So, here's our game plan for today. First, what is ASBA? Second, investor rules and benefits. Third, how to apply. Fourth, we'll go behind the scenes with SCSPs. And finally, we'll wrap up with the rules for issuers.
All right, kicking things off with Section 1, what is ASBA? Let's get right into the core mechanism.
ASBA actually stands for Applications Supported by Blocked Amount. When you submit an ASBA, you're essentially giving your bank explicit authorization to strictly block the application money in your account so you can subscribe to an issue. And honestly, the beauty of this mechanism is that your money never actually leaves your account during the application phase. It is only debited if and when your application is actually selected for allotment. If you don't get the shares, the money simply unblocks. It just stays put. It's really that simple. But here's the thing. You can't just use any random bank account to do this. And that brings us to the SCSB, or Self-Certified Syndicate Bank. This is a bank that is officially recognized by SEBI as being fully capable of providing these ASBA services. To actually use this facility, you need to hold a savings account with one of these designated banks on SEBI's list. It's essentially a curated VIP list, ensuring the banks have the right tech and regulatory clearance to handle the blocking process securely.
Moving right along to Section 2, Investor Rules and Benefits. Or, as I like to call it, your money, your control.
This next point is a massive relief for a lot of folks. The SEBI guidelines literally spell this out to reassure you. No, the entire bank account will not be blocked. Let's say you've got 100,000 rupees sitting in your savings account, and you decide to apply for 15,000 rupees worth of shares. The bank is only going to block that specific 15,000. The remaining 85,000, it's completely free and accessible for your everyday expenses, paying bills, whatever you need. Your financial life doesn't just hit a brick wall because you applied for an IPO.
Now, what's really interesting about this slide is this stark difference in withdrawal rules depending on who you actually are. If you're a retail individual investor, you have the awesome flexibility to withdraw your ASP bids right up to the closure of the issue. You just go to the bank with a signed letter. But look at the non-retail investors, your qualified institutional buyers and non-institutional investors. They absolutely do not get this privilege. They cannot withdraw their bids at any time. It's a rule specifically designed to give everyday retail investors like us an extra layer of protection.
And how many applications can you make? Well, that depends on what you're applying for. For public issues like your standard IPO, SEBI is super clear. Only one application is allowed per bank account. End of story. However, if it's a rights issue, the rules loosen up quite a bit. You can actually make multiple applications from a single bank account up to the specific rights entitlement you're applying for.
Okay, on to Section 3. How to apply. Let's walk through the actual step-by-step process.
If you're going old school, here is the standard physical submission playbook. Step 1. You submit your completely filled ASBA form to a designated SCB branch. Step 2. The bank blocks the authorized amount in your account. Step 3. The bank uploads your application details to the electronic bidding platform. But, quick word of caution here. While the bank handles the uploading, you are completely responsible for the data. You absolutely have to ensure details like your PAN and your DMAT account numbers are perfectly correct on that form. If there's an error on your end, your application is highly liable to just be rejected.
But hey, we live in the digital age. You aren't limited to physical paper forms. You have the total flexibility of applying either physically or electronically. You can hand in that physical form in person and get a counterfoil acknowledgement from the branch. Or, if your chosen SCSB provides the feature, you can apply seamlessly via internet banking or UPI, and the system will instantly generate an application number for you. It's really all about whatever is most convenient for you.
Let's move to Section 4 and see how this builds behind the scenes. We're looking at SCSBs and how they actually handle your data.
When your bank uploads your application to the stock exchange, they aren't sending over your whole life story.
The system focuses entirely on exactly what is necessary. They upload a very specific, secure set of data points: your application number, your depository participant ID, your client ID, the bid quantity, the amount, and your PAN. That's it. That is the exact package of information transmitted to the Stock Exchange's electronic bidding system on your behalf.
But the bank's job definitely doesn't end when the bidding closes. The SCSB actually has some pretty rigorous post-application duties. If you withdraw your bid validly, or if the whole issue fails, the bank must unblock your funds. They're also required to keep meticulous electronic records of all blocked and unblocked amounts for auditing purposes. They even have to retain those physical ASBA forms for 6 whole months, just in case there are any investor complaints to sort out. And finally, they send all the aggregate info to the registrar after the bidding period is over so the allotment can be properly reconciled.
Now, looking at these SEBI guidelines, there's a little catch you should know about. While the bank is absolutely responsible for uploading this data correctly and managing the blocking mechanism, they are not actually required to validate the application details themselves. They just follow standard banking diligence. So again, this just underscores why filling out your application accurately on your end is so incredibly vital.
Finally, Section 5, Rules for Issuers. Let's look at the mandates for the companies themselves.
The rules for companies trying to raise capital are completely uncompromising. Issuers must provide ASBA as the mandatory payment mode for all public issues. And when it comes to which banks can participate, the issuer has absolutely zero discretion in choosing SCSBs. Any bank registered as a banker to the issue and recognized by SEBI automatically acts as a deemed SCSB. So the crucial point is, ASBA isn't just an optional perk, it's a mandatory, system-wide safeguard built right into the fabric of the public markets to ensure transparency.
So there you have it. The entire ASBA process, totally demystified. Your capital stays right there in your own account, it's perfectly safe, and it's only debited if you actually score the shares you applied for. You hold all the power. Now that you know your funds are safe and seamlessly blocked, what is your next big investment? Thanks for joining me for this explainer, and keep on learning.